Good morning, everyone. Can you just let me know if you can hear me? Okay, can we start? Can you guys hear me, or do you have issues with the sound? Okay. Okay, great. So let's start. So today what we're going to do is we're going to continue with Learning Unit 2. Now, Learning Unit 2 specifically looks at your accounting equation and the double entry system, and we're going to do a few activities in class to try and cement the foundation for that. So what I want you to do is, if there's anything that you're wondering about or you have questions, please just stop me and ask. You can either type your question in the chat function, or if you feel comfortable, you can pick up the mic. Okay, I don't mind, whichever you prefer is fine. Okay, so these are the learning unit objectives that you need to be familiar with. So the ones we're going to focus on today is more your gross profit, net profit, and then the double entry rules, looking specifically at the accounting equation. Now, just to recap, when you do general ledger accounts, because some of the accounting equations ask you to debit and credit the accounts, this is just a high level sort of thing to help you out. Remember which account is being debited when it increases and which account is credited. Now, by using this abbreviation, date click, you'll see on the left hand side it shows you debit it if it increases. So you debit your expenses, your assets, and your drawings. And if it decreases, the opposite applies, the credit. And then the click is you credit your liabilities, income, and capital. Now, the items I've highlighted in red boxes, that is all the items that falls under your owner's equity category in your accounting equation. So your capital, your drawings, your income, and your expenses all affect your owner's equity. Now, your capital and your income will increase your owner's equity, whereas your expenses and drawings will decrease it. Okay, so this is just useful if you can't remember if it's a debit or a credit. So what I normally tell the students is just at the top of your paper, just write it down so that when you get to a question where you have to either do the accounting equation and show the debits and credits or the general ledger account, then this will assist you in putting the information on the correct side of the account. Now, just to recap, gross profit is our sales less our cost of sales, provide us with the gross profit. Now, remember that is your profit before we even take into consideration any overheads or operating expenses. So it is only our sales and cost of sales. Now, that cost of sales is what we've paid for it, and then the sales amount would be the cost of sales plus the markup percentage that our business decided on. Now we get two types of markup percentages which we can apply. The one is our normal markup percentage, which is the profit on the cost amount, and then you've got your gross margin, which is your profit on your sales amount. Okay, so we're going to look at that as well. So net profit, just a reminder what net profit is. So your net profit is then your gross profit plus any other income that you've earned less any other expenses would give you your net profit. So that is basically your profit after you've taken into account all overheads, all operating expenses. Okay, so it's important to know the difference between the two profits for a question when they ask you this, or if they ask you to explain what is the difference between the two. Now let's talk about your profit margins. There's two methods of calculating it. So the first method is on cost. We also call that your markup percentage. Now, how you work it out is you using your markup percentage that is provided in the question, and you divide it over the profit percentage on the cost. So normally if it's on cost, we say the profit percentage is 100%. Okay, so you'll see here at number 3, we say the cost is 100, our profit percentage and your sales percentage would be the 100 plus the profit. Now, if they give you a rand value, you take the rand value, you multiply it with what you have. So if I've got the cost percentage of 100, I would divide it with 100, and I want the sales percentage. So what you want is the sales percentage would be at the top, and what you have is the cost one at the bottom. So that is your markup percentage. Whereas your gross margin is this one, the second method. We use the gross margin percentage over the profit percentage of the selling price. Okay, so how we work it out is our cost is 100% less the profit percentage because of the fact that the sales percentage represents 100%. And then our profit percentage is added to give us the sales percentage. Similar way to calculate it, the only difference is which one is the 100% and how to calculate the cost price. Okay, so this is very important when we get to some of the questions to know how the difference between the two. Do you guys have any questions on markup percentages before we move on? Okay, then another thing we need to touch on is in Learning Unit 2, they touch on the fact that there's 2 different periodic inventory systems. The one is the perpetual inventory system and the other one is the periodic inventory system. Now, can you guys tell me what is the difference between these 2 systems? Okay, so I'm just going to repeat it. Do you know what is the difference between a perpetual and a periodic inventory system? Okay, so you don't know. Okay, so let's talk about it. So perpetual inventory system is basically a just-in-time inventory system. So that is making sure that at any point in time, if someone comes into your store and they ask you how much inventory we have on hand, you will be able to give them an answer. Now, the reason for this is because of the fact that we account for inventory in terms of the perpetual inventory system as an asset. Okay, so we show it as an asset, and that balance shows us what is the stock on hand. And then when we sell it, we account for the sales transaction as well as the transaction where we move that amount out of the inventory into the cost of sale or the expense account. Whereas the periodic system, every time you purchase the inventory, we account for it as an expense right from the get-go. Now, we only know how much stock we have on hand if we do a physical stock take. And that normally happens once a year at the end of the year. Now, periodic systems is used by small businesses that does not necessarily have the money to get these expensive stock systems to be able to account for their stock in real time. Now, once we've done that stock take at year end on a periodic system, then we go and calculate what was our actual cost of sales for that current year by taking all the different purchase or expense accounts relating to that stock, adding it together, and then adding the opening stock, deducting the closing stock, and then we get to the cost of sales. Okay, so that's the main difference, but now we're going to look at a summary page just to show you from an accounting point of view what is the difference. Okay, so you'll see here is the periodic table and here's the perpetual one. Now, routine purchases, now that's your everyday purchases of your inventory. So for the periodic, the cost is debited to the purchases account. So that is our expense account. Whereas under perpetual, the cost is debited to your inventory account, which is an asset account. Okay, so you can see when you buy it, the one goes to an expense account, the other one goes to an inventory account. Now, when we sell the inventory, for the periodic inventory, no accounting entries are made to the stock itself. Okay, you do make an entry for the sale of it, but not the stock is not influenced at all. Whereas under the perpetual inventory system, we have to debit the cost of goods sold and credit the inventory. So in this scenario, we are moving the stock that we've sold. We're taking it out of our inventory balance because we no longer have it, and then we're moving it to the relevant expense account so that we can work out the profit for that specific sales transaction. Now, both of them will have a sales transaction, but when we look at the inventory alone, the periodic will have no entry, whereas the perpetual will only account for the inventory that was sold by removing it out of our inventory balance and putting it into cost of sales. Then at the end of the period, so at year end, for the periodic one, we have to do a physical count of inventory to determine the cost of goods sold. So only at year end will we know what was our total cost of sales for our inventory during the year and what was our profit that we made. Whereas for the perpetual inventory system, no separate determination of goods sold is necessary because of the fact that we do it every time we sell that inventory. And that is the main difference between these two. Okay, do you guys understand the main differences between periodic and perpetual? Or do you have any questions for me on this? We will do an exercise to show you how to do it. I just want to know from a theoretical point of view, is there something that you're wondering about? Okay, if we do the question for this, just let me know if there's something that I need to re-explain, then we'll cover that as well. So in your textbooks, question 2.13, you will see there's 3 transactions. It is in the books of Georgian traders for March 2007. So they give you 3 transactions. Now the required, let's look at what do we have to do. So that's always where you start is what do you need to do to help you figure out what to do with the information they've provided. So show how the mentioned transactions will affect the accounting equation and how the accounts in the general ledger will be affected under a perpetual inventory system and under a periodic inventory system. So what they want you to do is using the accounting equation as set out here, you have to show the different categories, so your asset, owners, equity, liabilities. Then you show does it positively or negatively affect that category, and just underneath it in the specific category, what general ledger account is being debited or credited. Okay, so that is what they require from you. That's the first thing. But then you'll see they also ask you to do it according to the perpetual inventory system. So we just said perpetual inventory system, inventory goes to the asset account. And when we then dispose of them, we move them to cost of sales, which is the owner's equity account. Whereas under the periodic system, it goes directly to your purchase account with owner's equity. And when we sell it, we don't remove any inventory, or we don't have a transaction for the inventory as such. Okay, so what we're going to do is we're going to go through each transaction, and then I want you guys to tell me where do you think it is going in this equation and how it will affect it. Okay, so let's look at the first transaction. We said we purchased inventory on credit for 18,000 Rand. Okay, now if you purchase inventory on credit, let's start with the perpetual inventory system. How would we account for it? Okay, so let me repeat this. If we purchase inventory on credit, how would you account for that in our accounting equation? So let's start with the perpetual inventory system. You guys can either pick up your mic or you can just type in the chat function, that is fine. If you don't know all of it, you can just give me the information that you do know. Okay, do you guys know how to do this? You can just indicate in the chat function where you're at so that I just know what's going on. Do you guys know how to do this? Can you just let me know in the chat function? Okay, so Maseko says we're going to debit inventory and it's going to increase by 18,000. Okay, Maseko, the inventory, under which category will you place that? You guys can abbreviate. So for assets, just give me an A. For owner's equity, OE. And a liability, just an L. Okay, so that's correct, Masifo. So we're going to debit inventory. We're going to increase it with 18,000 in terms of the perpetual. We're taking it to the asset account. If we buy something on credit, have we actually paid for it yet? Okay, so if we have not paid it, do we still owe someone money for it? Okay, that's correct. Yes. So if we owe someone money, what did we say? What category does that fall under? Liabilities, that's correct. So our liabilities is also going to increase with 18,000, but what general ledger account will it go to? What general ledger account do you think it will go to? if I buy something on credit, what's the account I'm going to take it to? Where do we put credit purchases? Okay, I'm going to help you out here. So when we buy something on credit, we credit our creditors control. And the reason we call it a creditors control is because that account is a summary of all of our creditors balances. Okay, so it's not only one specific creditor, it is all of them. Okay, so that's the first transaction. Now, if we do a purchase of inventory on the periodic inventory system, how is this going to change on that table? So tell me, what are you going to change if we purchased inventory, but we now have to capture it in terms of our periodic inventory system? What is the main change? You guys know. So the first one we did a purchase in terms of the perpetual inventory system. So we took it to trading inventory. Where did I say we take it when we do a periodic inventory system? What account does it go to when we do a periodic inventory system? I'm going to put something up and then you can tell me. Okay, based on the slide, if we do a periodic inventory system and we purchase something, where do we take it? Okay, Cecile, where creditors control will always be a liability, so that's not what will go to owner's equity. So you're on the right track. Yes, you will put something in owner's equity, but it's not going to be creditors control. If you look here on the screen, instead of the inventory account, we're going to use a purchases account. Okay, so let's quickly have a look and see what it looks like if we do it in the periodic system. And then I'll put the two next to each other so that you can see exactly the main difference. Okay, so let's just make it slightly smaller, then we can compare the two next to one another. Okay, now if you look here, on the left-hand side is the periodic, the perpetual system. On the right-hand side is the periodic. So if you look at what we said, okay, there we go. Now you can see both of them. The main difference is this. So I'm going to bold this and make it red so that you can see the main differences. Okay, so all that's going to happen is if we do perpetual inventory system, I would have taken it to trading inventory, which is an asset account. Okay, so I would have taken to assets. Whereas in the periodic inventory system, I am taking it to the purchases account, which falls under owner's equity. Okay, wait, this is actually a negative and not a positive. Okay, so what happens here is I've literally moved it from one category to another one, but the way I pay for it will always remain the same, irrespective of which inventory system I am on. Okay, so Seliwe, does that make sense to you? Do you understand this? Okay, great. So let's go look at the next transaction. Okay, so now the second transaction, we say we paid 2,000 Rand from our petty cash for railage of purchases on the inventory purchased on the 30th. So what they're saying is we paid for the transportation cost, 2,000 Rand, and we paid it out of petty cash. Okay, so let's start with the easy part of it first. Where did the money come from? How did we pay for the railage? Petty cash. Okay, petty cash falls under what category again? Under assets. Now, if we pay it out of petty cash, that means our petty cash would have decreased. Okay, so let's see. So petty cash we know is an asset, so we will decrease our petty cash. Okay, and it will be exactly the same under the periodic system. Okay, now the question is that railage, that 2,000 Rand that we paid to get our inventory to its location. What do we do with that? Do I account for it as an asset? Do I take it to an expense account? What do you guys think? Okay, so let me repeat that. That cost of getting your inventory to its location. Do we take it to the asset account or do we take it to expense account? Okay, so let me help you out. So under the perpetual inventory system, any cost that you incur to bring that inventory to a location and condition necessary to sell it will always be capitalized to your inventory account. So for that reason, we would debit our trading inventory with the 2,000 Rand. Whereas under the periodic system, we will take any cost relating to the purchase of inventory to that specific expense account. So that means we will debit railage on purchases under the periodic. So if we look at what the differences are. Under your periodic, we're taking it to the railage on purchases account. Whereas under the perpetual, we took it to the trading inventory. Okay, so you see the one always goes to the asset accounts and the other one always goes to an expense account. Now let's look at the next transaction and see how that differs. Now we're selling all of the inventory we've purchased on the 13th for cash. Okay, now it's important here that you see that we're selling all of the inventory. Now the reason we need this is we need to know when we move something from inventory to cost of sales, what was the actual inventory we've purchased. This 27,000 represents the sales value and not the original cost. Now remember when we said we do perpetual, we would do the sales transaction as well as the cost transaction. So moving the item out of the inventory account into the cost of sales account. Whereas in the periodic system, we're only going to do the sales account. Now let's go look at what does that actually look like. Okay, so let's start with perpetual. So I said perpetual, we do the sales transaction first. So we debit the bank, the cash that we received in, which is in the asset account, and we credit sales, which increases our owner's equity. Now, if we look at the periodic system, that entry is exactly the same. There is no difference in that entry. Where the difference come in now is the next entry. Under our perpetual inventory system, we now take out the amount of stuff we sold. Now they said we sold everything. So that means the 18,000 plus the 2,000 gives me a 20,000. So I'm going to decrease my trading inventory with the full 20,000. And then I'm going to move that full amount to the cost of sales. Now cost of sales is an expense account, and that is why it is decreasing our owner's equity. So how it differs from the periodic one is this transaction. Specifically, moving the item out of the trading inventory account, the asset account, and moving it into our expense account so that we can account for the profits for that specific sale. Okay. Do you guys have any questions on the two different inventory methods? You can expect to see something like this either in your test or in your assignment, potentially also in your exam. So you guys need to make sure that you understand this. Do you guys have any questions on this? Is there something I need to re-explain? Okay, let's continue then. Okay, so what we're going to do now is we are going to do question 2.11 in your textbooks. Now, for this one, we're going to do the accounting equation again. So we're going to practice it again. But two things that you need to note in here that was not in the previous question. In this one, we've got a markup percentage of 50% on the cost. Now we need that information when we need to do that entry that we discussed, where we move it from inventory to cost of sales. They will give you the sales value, but instead of telling you it's all the inventory, they're giving you the markup percentage, which means you need to then go calculate the cost of sales. Okay, so this is something that you can expect. They generally ask it in this manner in a test. What is important to note here, ignore that, so we don't have to account for that as yet. And what inventory system are we using? Okay, so perpetual inventory. Where do we take perpetual inventory? If we have an inventory account, inventory we've purchased, where do we take it? Okay, so let me repeat that. Perpetual inventory system, when you hear that word, do you think of an asset or do you think of an expense? That's correct. It goes to the asset account. Okay, now let's quickly do the markup on cost. Now remember we said markup percentage of 50%, that's your profit. When they say it's on cost, that means your cost percentage is going to be 100. Okay. Your markup percentage is 50, which means your sales price percentage is then 150. So it's the 100 plus the 50. Now that will be important when we do the sales transaction to work out the cost of sales. Okay, so let's start with the first transaction. The first transaction says the owner took clothing from trading inventory for personal use. The selling price was 1,500. Okay, if our owner takes something out of the business for personal use, to which account do we take that amount? So if our owner takes something out of the business for their own benefit, where do I take it? To drawings, that's correct. Okay, under which category does drawings fall? Okay, so you have an option of one of three. It's either asset, owner's equity, or liability. Where does drawings go? Owner's equity, that's correct. At what value do we take that inventory that the owner has taken out? Do we take it out at the sales value or the cost? When an owner takes something out of the business, will he take it out at the sales value or the cost? Okay, the cost. Remember, you as the owner will not pay the markup. You will refund the business for what it actually cost them. So that's why this markup percentage is so important. Okay, so let's go see how we account for the first transaction in our Excel sheet. Just going to make it a bit bigger so that all of you can see properly. Okay, so the first thing we said, we are going to take it to owner's equity to drawings account. To calculate the cost, I'll show you. Okay, and we're going to decrease the trading inventory. That's where it's coming out of. So to calculate the cost value, we take the 1,500, which is the sales value. We multiply it with 100. So I said our cost represents 100 because the markup is on cost. Our markup percentage or profit is the 50% that was given to us, which means our sales price percentage is the 150. So that is adding the other two together. Okay, so that's where I got to that. So we had the sales value, we had this one, and I wanted the cost price. So at the top, I would have multiplied with 100. So what do I want? I want to calculate the cost price, and I divide it by what do I have? I have the sales price of 150. And that's how you calculate the cost for the amount he took out of the business. Okay, let's look at the second transaction. Okay, we paid SA Prop by EFT for trading inventory purchased to the value of 10,000 Rand. Okay, this is similar to the previous transaction we did in question 2.13. So I expect you guys to be able to tell me what is the entry. What are we debiting? What are we crediting? And the category. Okay, if I buy something on EFT, how did I pay for it? Okay, guys, how would you account for this entry in our accounting equation? Okay, what I think I'm going to do is I'm going to work through this with you guys because it doesn't seem like you guys know this very well. I want you guys to make sure to go do the homework. They will ask you this. This is where a lot of you actually lose easy marks because you just don't understand the concept. So let me explain it to you, and then if you've got questions, you can ask me, and then you can go attempt the homework ones and see if there's anything else that you are struggling with. Okay, so let's go through the second transaction. If I paid it by EFT, I've paid it with money. That means that money came out of my bank account. So my bank account reduces with 10,000 Rand, and my bank account is an asset category. Trading inventory, on the other hand, because I'm busy with a perpetual inventory system, I bought trading inventory, so my trading inventory will increase because we said perpetual goes to trading inventory, which is an asset account. So when I account for this transaction, both transactions will sit under the asset category. So it will increase and decrease with the 10,000 Rand, but it will just move from one account to a different one. So my bank account has decreased, but my trading inventory has increased with the same value. Okay, so that is how you account for the purchases. So let's look. On the 10th, we purchased office computer, and they tell you to take it to computer equipment, so that's the general ledger account, on credit for 5,200. Now, if I buy something on credit, I haven't physically paid for it. So I still owe someone money, which means it's a liability. Now, any money that I buy on account is called creditor's control. So what will happen is I take computer equipment as an asset, so that will increase, and then my creditor's control, which is the liability, will also increase to reflect the purchase that I've made. Okay, so that means we debit computer equipment, we increase it with 5,200, which is the asset category, and creditor's control is the amount I've bought on credit, and we also increase the liabilities for 5,200. Okay, so that's how I account for that specific transaction. Then on the 15th, I've got credit sales of trading inventory. So I sold my trading inventory to my customer, but they haven't physically paid me. They still owe me money. So if someone owes us money, it is called an asset. And if we sell it to someone on account, it is a debtor's control account. Okay, but this is where the markup becomes important. We said that the sales transaction will show at the selling price, but under the perpetual inventory system, when we sell inventory, at that point in time, we move it out of the inventory account to reduce our stock value on hand, and we take it to the expense account so that we actually know what is the profit we made. So let's go look at how will I account for that transaction. Okay, so the first transaction you always start with, and this is the one that you guys always get right, is your sales transaction. So you credit sales, which increases your owner's equity, and you debit your debtor's control, which increases your asset account. But now we need to work out what is the cost of sales value. Okay, now the cost of sales is based on this amount. Now remember, we always work it out on the amount excluding VAT. Now because of the fact that VAT was not considered here, we don't have to worry about the VAT component. Okay, so that means we take the 4,470. Let's go look at this table. That amount currently represents 150%, but I want to know what is 100%. So I'm going to divide that amount by 150, and then I'm going to multiply it with the 100 to work out what is the value. Now, the first step is we take it out of the inventory. So we're reducing our stock on hand balance with the amount we've sold, but at the cost price. And then we take that same value to the cost of sales account, which is the expense account, and we're debiting it. But as you can see, If we debit cost of sales, which is an expense, it decreases our owner's equity. Okay, so that is how we account for a sales transaction. Now I want you guys to try it on the next one. So on the 27th, now we've got a cash sale of trading inventory, and the selling price is 6,950. Okay, so let's start with the sales transaction. What account am I going to debit? What account am I going to credit? Okay, so we've got a cash sale. What am I going to debit? What am I going to credit? Okay, if I sell something cash, where does the money go? Come on, guys, I've just explained the credit sales. So how will the cash sale differ from the credit one? I'm going to put it up on the screen, the one we just did. Okay, now remember the new value is 6,950. Now if we look at the credit one, how am I going to amend it for the cash sale? What will change? Okay, so you think it's going to debt. Okay, we're going to change debtors control. That's correct. So instead of debtors control, we are going to take it to bank because they've paid cash. Okay, so it's not on credit. If it's in cash, it goes to the bank. But we're still going to credit the sales and we're going to debit the bank. Now just tell me, how are we going to work out the cost of sales amount based on the sales transaction? What is the formula that you are going to use to work out the cost of sales value? You can just type the formula in the chat function for me. Okay, let's repeat this again. So similar to the previous one, I'm taking the original sales value. That represents the 150. So I'm going to divide it by the 150 and I'm going to multiply it with 100 to give me what is the actual cost of sale. Okay, and that is what I'm going to deduct from trading inventory and deduct from owner's equity. Make sure that you guys know how to do this calculation. They will ask it, and it normally is quite a number of marks, so you don't necessarily want to lose those marks. Okay, let's quickly look at the last two transactions. So we returned some goods purchased and received a cash refund. So if we return goods, our inventory will reduce, and because we received money, it will go to the bank account. And the last one is we received dividend income. So dividend income is an income, and we received it in the form of money, which will also go to the bank account. So to account for those two transactions, the first one, because we return the inventory, our inventory will decrease and we will increase the bank, whereas the second one, we increase the bank with the dividend income we have received. And that is how you would account for these transactions in your accounting equation. Okay, what I want you guys to do for me is just send me an email, and then I'll send you the slides for this session and the previous sessions, as well as this Excel sheet, so that you guys can go through it and revise it when you are at home. Okay, so your homework that you have for next week is I want you to do question 2.14, 2.60. Now that is based on our inventory systems as well as our accounting equation. Then I want you to read Learning Unit 3, which talks about VAT, so that when we discuss it in class, that we can go through it a bit faster. And then the questions we will discuss in class next week is question 3.3, 3.6, 3.7, and 3.8. So I want you to attempt it so long to see if there's specific things that you guys don't understand, so that we can address it in class. Okay. Do you guys have any questions for me?